Good morning. Thank you for joining us this morning. We'll be starting our webinar shortly. Thank you. Good morning. Thank you for joining us for our webinar today. We'll be starting the session in a few minutes. Thank you. Good morning. Thank you again for joining us. We'll be starting our webinar in a few moments. Thank you. Okay, it's the top of the hour. Good morning. We trust you are doing well. We would like to welcome you to our Sikich webinar on where tax legislation stands now. My name is Jim Brandenburg, and joining me today is Jenny Kramer. We're both tax partners with Sikich. Before we begin our session, a few housekeeping items for today's session. We encourage you to submit questions in the question feature on the control panel. We anticipate many questions and we'll do our best to answer them, but if we're unable to, a Sikich team member will follow up after the webinar. Today's slides can be downloaded from the handout section of the control panel. In addition, there are several other resources we have included there. Again, this webinar is eligible for CPE. So for CPE credit, polling questions will launch throughout the webinar. You'll need to answer all three of these to receive your CPE credit. Okay, let's look at our agenda for today's webinar. There's been much speculation on possible tax changes actually going back to last year's presidential campaign. The administration rolled out its tax proposals earlier this year following the passage of the American Rescue Plan. We'll revisit these two proposals, the American Jobs Plan and the American Families Plan. The battle for tax changes actually takes place in Congress, and Congress has been working on this legislation really all summer. While it may not seem like anything has happened, they have moved the process forward and much has been done behind the scenes. The stage is set for a flurry of activity in the coming weeks to finalize this legislation. So with that, again, we'll turn the session over. Again, we'll go through, again, these proposals that have gone through, and at the end, we'll have some tax planning observations on some things to consider as we move ahead. So with that, let's turn it over to Jenny, who will address the American Jobs and Families Plan and review that. Jenny?
Perfect. Thank you, Jim. Yep, as he mentioned, we are going to backtrack a little bit first, and we're going to refresh on what was included in Biden's administration's American Jobs Plan and American Families Plan released earlier this year. Because these are the framework for what the administration administration wanted Congress to draft into legislation and approve. So while we're in the midst of that process, these are our best indicators of what tax provisions might be included in the legislation that is currently being drafted. So we're just going to walk through that really briefly here. Again, the American Jobs Plan was that physical infrastructure proposal that equated to about $1.7 trillion in spending that would be paid for, presumably, with tax hikes on businesses at that time when that information was released. The American Families Plan was the corresponding intangible family infrastructure items, which focused on $1 million in spending to invest in, some of the framework laid out at that time was preschool education, a certain number of years of free college tuition, and then 0.8 trillion of that was geared towards incentives like enhancing the child tax credit and earned income credits. So that American Families Plan was looked at being financed with $1.6 trillion of additional individual income taxes. So those were kind of the two pieces that were broken out in those plans laid out much earlier in the year by the administration. So I'm just going to cover briefly some of those income tax items that were included in that plan, because like I said, that's going to be the framework that we're still working with and looking to see what Congress is actually going to include in the law. So that's going to start with first, potentially higher individual income tax rates. Back in 2018, when we had the Tax Cuts and Jobs Act, one of the items there was dropping that highest income tax rate from 39.6% to 37%. So the American Families Plan proposed increasing that top rate back up to 39.6. One of the items, as there are many unknown in this very loose framework that was laid out, is where that would actually apply. As you'll see, the theme throughout many of this information that stayed consistent since those plans came out, they've pledged not to increase taxes for anyone under $400,000 of income. We just don't know where those guardrails will come in or when this type of increase will be plotted. A little bit more significant and on top of mind for many people, I'm sure many of you, is that higher tax rate on potentially long-term capital gains and dividend income. So currently that rate sits at 20% as the highest income tax rate on that, plus in most situations an extra 3.8% is added to that for that net investment income tax, which results in a 23.8% rate right now. So the verbiage in the American Families Plan would actually, for taxpayers with income over $1 million, move that 20% rate up to that highest 39.6%, the ordinary income tax rate. And in most cases, the 3.8% net investment income tax again would apply. So this is significant. This is going from that potential 23.8% top rate all the way up to a 43.4% rate. So this is a space where there is a lot of planning, a lot of discussion right now, even though we don't know timing or actuality of this coming in. So we'll touch on that more later, especially when we get to our practical planning perspectives. A few other items included in these plans related to income tax items, or in this case, actually the estate tax. That's another item that could be updated or changed. And one specific that was included in those administrative plans was eliminating the step up in basis at death for appreciated property. So under current law, fundamental item that's been kind of part of our estate tax system for some time is that as property passes to its heirs, the recipient's tax basis in that property moves up to the fair market value at the time of that person's passing. And what that does is mean that if that recipient turns around and sells that property, they don't incur a gain at that time. They don't incur a gain that's subject to tax. So obviously very much a strong piece of protection for somebody looking to transfer wealth. And so this is just an item that, the framework indicated that they would potentially have $1 million exemption, and that they're trying to vow to have protections for family-owned businesses and farms so that they can still pass it to their heirs, and those heirs can continue to run the business. And in no way would these changes have implications on them, because that's obviously very fundamental to keeping small businesses strong here in the US, but it remains to be seen how that would be applied or if this will be part of coming legislation. So we already have a poll question to see that you're here and awake and tuning in. So I'll let Jim read that off for you.
Again, we have 3 polling questions. Our first one, what proposed tax change do you think will impact you the most? And again, our selection choices here, higher individual tax rates, higher corporate tax rates, higher tax rates on capital gains and dividends, a change in the estate taxes, or none of the above. So you have a few moments here to indicate your selection on this first polling question. Thank you.
All right. Perfect. Thank you, Jim. All right, just giving everybody a few more seconds to get their answers in. Again, this aspect is important for if you're doing CPE.
Okay, here's our results on the first poll question. Interesting here again, 33%, again, about a third, you indicated the higher individual tax rates, but the highest one, again, 41%, higher tax rates on capital gains and dividends, and then smaller amounts for corporate taxes and estate taxes. So it's interesting, again, as Jenny mentioned, that significant increase in the capital gains and dividends is drawing a lot of attention here. So good. Thank you very much for answering the poll here.
Sure. No, thank you, Jim. All right, moving just through a few more items that were part of those American Jobs Plan and American Families Plan that we want to keep in mind for the themes that we're going to keep seeing. Another one kind of paired with that capital gains treatment, again, how do I defer tax if I am in a high tax rate environment or capital gains environment? And one of the tools in our tool chest for that was the like-kind exchange. This was somewhat limited by the Tax Cuts and Jobs Act. So starting in 2018 and beyond, this was only available for, now it's only available for real estate. In the past, there was other items that could be exchanged and the gain deferred. But we are in an environment now where it does only apply to real estate. There is obviously a lot of instances where that can still happen. There are very specific rules that have to be followed, but presumably you are selling one piece of property within a certain time period, 45 days, you've identified a new property and then you actually acquire it within 180 days. And in doing so, then you're rolling the proceeds from one property into another and thereby not recognizing potential gain that you had on that original property disposition. So the limitations mapped out in the administration's framework was that they would limit this to potentially only a $500,000 deferral that could happen. Unsure of a lot of specifics there, but that was another item to keep in mind, especially with potentially increasing capital gains rates. And then I did mention a few times when we were talking about capital gains and otherwise, there is this 3.8% net investment income tax, and that's been in place for many years since the additional healthcare ACA rules came into place. This was an offset at that time. And right now, that does only apply to mostly investment type income. There are exclusions specifically for business related income. But one of the proposals was that this would just apply across the board now. And so it would apply to your business income. So again, adding on another 3.8% on top of whatever income tax bracket you might be in for all sources of income is just another little edge up in those tax rates. A few other items that we call, tax-related revenue raisers that were part of the administration's plans also was that they were pledging to put additional resources towards IRS enforcement of audits and compliance. We know as practitioners, and I think many of you know as taxpayers, we'd like to see more dollars being put towards the IRS and just their day-to-day administration and being able to service the taxpayers and tax practitioners. But this is a carve-out item specifically that they feel they can raise money in regards to further enforcement. It's interesting how they would actually focus that and whether they can still say that they're not targeting taxpayers earning less than $400,000 in this instance, because obviously those enforcement measures would be applied across the board. Other items that they alluded to would be an expanded focus on cryptocurrency reporting, which we're going to touch on later. We'll see how that came into play, and enhanced reporting, matching, and reconciliation. How are they going to actually identify or feel like they can find missed taxpayer compliance? So they feel like they've analyzed the studies and there is an apparent significant tax gap in unreported income, and that is a measure that they can raise revenue with. So that was an item cited in those plans as well. So again, these were proposals of general themes on tax changes, but they were really short on specifics, and it's still the job of Congress to draft the actual legislation. So from here, I'm going to hand it back to Jim, who's going to lead us through some of the details of the congressional process so far.
Thanks, Jenny. Very good overview with it. And again, we thought it was helpful just to kind of refresh, get people back to where that original proposal was with it. We turn now to Congress. Again, Congress, as Jenny mentioned, they actually draft the legislation. Administration can offer proposals, but it's actually Congress that drafts it. They vote on it. Again, it's got to go to the House and Senate. And if a bill does pass, it moves back to the president to be signed into law. Legislation normally begins in the House, and if it's passed there, it moves to the Senate. That's just the way that it's set up. Congressional leaders, however, this year decided to change their approach, and instead, when they moved this infrastructure legislation, what they were looking at doing is to move that first in the Senate and then move it back to the House. The other thing that they did is they really split the legislation into two bills, and you've probably heard some of this talked on it. One is this infrastructure bill, again, mostly physical infrastructure items. And again, somewhat similar to some of the items that were in the American Jobs Plan that Jenny talked on. And then secondly, into what they refer to almost as an individual infrastructure bill. And again, that includes many of the items in the American Families Plan. So they have these two separate bills that they have that they split that are separate but yet almost linked together. And again, starting in the Senate rather than the House. Okay, next what they did, besides moving these two separate bills, they're going to have a different set of rules with them. The infrastructure bill was approximately $1 trillion with it. And what they're going to have with that is that's going to operate under what they call the normal rules in the Senate. And that would mean that it needs a 60-vote hurdle to pass. Now, again, the Senate is split 50-50 between Republicans and Democrats, so it needs to have a bipartisan support with it. The infrastructure bill that moved forward actually had 22 senators who were in a bipartisan group that helped put that together, and we'll talk on that a little bit further with Jenny. We'll go through that. So anyway, they decided to do that, but then the reconciliation bill is a $3.5 trillion. It's a separate bill, and that's the individual infrastructure portion of it. And that's moving under what they call this reconciliation. And that's a specific term within Congress and within the Senate as a complex set of rules. And generally, there's only one reconciliation bill that's done a year. And you may recall that the American Rescue Plan earlier this year that provided some additional COVID relief, that was also under reconciliation. Well, I think what Congress had is they had one left over from last year, so they used one for the rescue plan, and they're going to use this other one for this reconciliation for this American Families Plan, if you will, the individual infrastructure going through. The difference with this reconciliation, though, is it'll be a partisan bill, and it just needs a simple 50 votes in the Senate. So it can pass without any Republican support for it. So the individual infrastructure will be a partisan bill, and it's going to be handled much differently, and we'll talk about that a little bit, than the bipartisan infrastructure bill. So as it moves forward here, Jenny, go. The next slide we've got here is, here's some of the key, especially in the Senate, senators dealing with the infrastructure and reconciliation packages. Some of these you may be familiar with, but just keep in mind with this, and not only you've seen it this summer, but as we get into the coming weeks here, they're going to play a key role. That Senate Majority Leader Chuck Schumer, Senate Budget Committee Chairman Bernie Sanders is actually drafting most of the, or putting together the reconciliation package is all going to be under him, and he's got several parts of that. They're going to go to different committees, but he's going to be in charge with that. The Senate Finance Committee is Ron Wyden, who any of the tax provisions that we've talked about, Jenny mentioned earlier, and we'll go through later, we'll go through Ron Wyden, so it's important to keep an eye on what he mentions. Joe Manchin is, we just put him on here, is not that he's a key part of this process, but he could be a swing vote if he, again, with the 50-50 vote here, especially with this reconciliation package, any Democratic senator who doesn't support it, could knock the bill out. So he's a key one to watch to see where he falls with this bill. And then Vice President Harris is actually the Senate president of the Senate. So if we have a tie vote, if it's a 50-50 vote, the vice president actually would cast a tie-breaking vote for a reconciliation bill. Then lastly, Mitch McConnell is the Senate minority leader, who again had some input with the infrastructure bill, but a little with this reconciliation package. So with that, what we're going to do is move on to, Jenny will go through this bipartisan infrastructure plan that moved through the Senate just a couple of weeks ago here. Jenny?
Perfect. Yes, thank you, Jim. Thanks for those insights into the congressional process. I always find that very interesting because as a result, as Jim mentioned, so the bipartisan infrastructure plan was passed by the Senate by a vote of 69 to 30 last week on August 10th. And this ended up as a $1 trillion overall bill for those physical infrastructure items. And it requires $550 billion of new funding. So it was initially projected to be paid for in full with corresponding offsets that we'll go through. But when the Congressional Budget Office report was issued late in the process, they did estimate that it's actually going to require $256 billion of debt financing to cover everything. Congress was, down the road that they were and decided that they weren't going to look back to potentially cut out projects or source additional funding. So they have decided that the debt financing is okay at this time. So that bipartisan infrastructure plan, again, voted on by the Senate and passed at this point there. These are a few of the items that are in there in regards to that new funding and those physical infrastructure items. Obviously, a lot related to roads and bridges, transit, broadband. You've heard a lot of this in the news if you're following along a little bit. So these are just some examples of those physical items that are important. So really, what are the pay-fors in this item? What's going to pay for this? And you'll see that these are very light and actually no income tax consequences yet in this bill. And so what is paying for this? What we do have is the drawback of some of the unused funding from those various COVID-19 relief bills that we've had throughout the last year and a half. Obviously, they earmarked a lot of resources for those items, whether it be different grant programs, different loan programs, and they're basically, if funds are unused at this point in time, they pull those back. There's a proposed delaying a scheduled change in Medicare prescription drug rebate rules. Revenue from future spectrum auction sales, so those broadband auctions, those bring in revenue to the government, and sales of other government assets, as well as, the government would be projecting that there would be additional revenue gained from the expected economic growth effects of this bill. The very limited tax-related pay-fors in this bill result in one of the items you've probably heard a little bit on is the debate on the cryptocurrency regulations. This is an item, when we were talking before in regards to gaps in reporting and where the administration or the IRS sees that there could be uncollected revenues. This is a key point, but it's also very controversial. So this is an area where it's new innovation. It's a relatively young area in all respects. And the debate is whether to further regulate it during a time when innovation in this area is occurring so quickly versus taking the time to really fully define aspects so that the regulations can be applied uniformly and followed by all. Right now they're saying they want to instill information reporting requirements on brokers, but we don't really know how to define what a broker is in the world of cryptocurrency right now. And we'd actually potentially, we don't even know if the individuals or businesses who would be deemed brokers would have the information available to report that. So that's one of the controversial items. And yes, they see it as a strong revenue raiser, maybe about $28 billion. They just don't know if there's enough information to hold taxpayers accountable for this at this time. So that's one that could actually, it was really still being debated. And now that the bill has moved on to the House, this is an item that will continue to be debated from what we're seeing. But that's one of the pay-fors that you could say is a little bit more tax related. The other item would be an early end to the employee retention credit. That is a credit that we've talked on in other webinars, very valuable, that can still be utilized by taxpayers right now if they have a certain decline in their gross receipts still from pre-COVID times. And so that would go right now, it's set to go through the end of the year, but in this case, they would pull it back and drop it for the fourth quarter. A few other items would be reinstating excise taxes on chemicals, and some various interest rate and bonding type items. So those are essentially what the pay-fors we see in this infrastructure bill that's gotten through the Senate, at least. They didn't, other than the cryptocurrency aspect, really look at the additional revenue collection items in audits and compliance. And there, again, is no major business or individual income tax rate changes included in the infrastructure bill. So there's a lot left over and still to be addressed. All right, we want to grab another polling question here.
Good, very good, Jenny. Thanks for the overview on the infrastructure plan. Our second polling question here is, what do you think the top individual tax rate will be after Congress finishes up its legislation this year? The choices are 39.6, 42%, 45%, or no change again, which would leave it at the 37% where it is right now, or unsure. So if you have a moment there, just indicate your selection on this this polling question. Okay, we'll give you a few more moments on that. It's helpful to get some of the insight here from our audience on some of these topics as to what's coming along here. Okay, here's our results. Again, 39.6 is what looks like the over 61% came up with that. 20% at 42% and 5% at 45%. And then again, a few with no change. So again, 39.6 is what it was before, as Jenny mentioned, before the Tax Cuts and Jobs Act. And that's what they're looking, perhaps had proposed earlier to get it to that rate. So we should find out soon as to what Congress introduces with that. So thank you very much for that. Okay, as Jenny mentioned, she went through the bipartisan infrastructure bill that again has gone through the Senate. It passed with that sufficient vote to get over that 60 vote hurdle. Now we're going to go through and look at again, I refer to it as a partisan reconciliation bill. Again, this is going to be just the Democratic leadership pushing this through and what they're going to have with that. And again, this is 3 to 4 times the size of the physical infrastructure. And again, they referred to it as an individual infrastructure focused on families. Again, 3.5 to some have said up to $4 trillion in spending. And there's 4 main areas that are in this package for additional spending. Again, a lot will be in this bill when it's all put together, but here's some of the themes they have. Families, they're going to look at creating some pre-K 3 and 4-year-old for child care benefit, make community colleges tuition free, extend the tax cut for families for the child credit and earned income credit. We'll talk on that a little bit. And then establishes paid family and medical leave will be one of the other benefits. Climate change, there's efforts within this bill directed toward that for U.S. efforts toward expanding. There's a number of programs within it, and also provide some clean energy, manufacturing, and transportation incentives to get toward some climate changes. Some additional infrastructure besides what was in the infrastructure bill, some to invest in public housing, green housing, and other housing production, and affordability will be part of that. And it's even creating a new civilian climate corps will be part of it. And then healthcare is another incentive or another theme within this package, focusing on universal healthcare, adding vision, dental to the Medicare benefits, and extending parts of the ACA, some of that which was included in the American Rescue Plan earlier in the year. So again, these are some of the main spending themes that are out there. Again, what we're going to focus on now a little bit is turning on what are some of those pay-fors that Jenny had mentioned before in the individual or in the regular infrastructure one. Now we're going to look at some of the pay-fors in the individual infrastructure bill here, this reconciliation package. One thing just to note is a couple individual provisions that are going to be in there. One is the child tax credit. Again, that was extended, with the rescue plan. The credit had been at $2,000 per child. It went up to $3,000 with that rescue plan. And then if they're under age 6, it's a $3,600 credit. And then what also started, some of you may be familiar with it, under that rescue plan, they started paying that that child credit on a monthly payment, and it started in July this year. So they took half of that credit for the year since the bill passed in March. They were going to pay that credit in advance to individuals that qualified for it and make that on a monthly payment. What they're looking to probably do in this package is make that permanent. So they would continue on to have these on a monthly payment. Some are saying almost like you've got Social Security now for retired individuals. Now you're going to get this monthly payment here for families that have children that would be continued as part of this package. Another one of the changes or incentives for individuals is the SALT cap relief. Again, SALT came in with the Tax Cut and Jobs Act. There was a $10,000 limit on your state and local taxes. This will be a hot issue within Congress in trying to come up with this, whether they have a full repeal of that $10,000 limit or maybe a partial repeal. So some are saying that what they might do is increase that $10,000 up to $15,000 to $30,000 to just increase the amount that individuals can deduct. Others are indicating is just have a income threshold, maybe $400,000, and those under that can deduct all their state and local taxes, but those above it would not. It's a political challenge because some, members of Congress want to get this SALT repeal out fully because they feel that it hurts their state more. But others are saying, well, that it might look like they're favoring the wealthy by getting rid of that SALT cap that's out there. So we'll see how that plays between the Senate and the House on there. Okay, so those are some of the changes. Here's some of the offsets, again, that Jenny had mentioned before that were part of the American Families Plan that will probably be incorporated into the bill that they're working on now. Again, that's going to work through Senator Ride in the Senate Finance Committee. Again, higher corporate rates, higher individual rates, perhaps higher capital gain tax, some estate changes. Again, those IRS enforcement that Jenny talked about, those were not part of the regular infrastructure package, but will likely be part of this individual infrastructure that they will include in there. And again, what they've stated and have indicated is the goal is to those with under $400,000 would not have any income tax increases. At least that's the stated goal with it. And again, we'll see if that comes to comes to pass that way. Again, besides those rates, I think one thing that's helpful to take note of is what may end up in this package here when it comes out here in a couple of weeks. Senator Wyden, again, chairman of the Senate Finance, has introduced several bills, some even within the last couple of weeks. And again, with his role as leading this package and writing it, some of the ones that he's introduced separate legislation may end up being part of the bill. There was a Clean Energy Act that he had that provided a number of green energy incentives that came about in April that he introduced. The Small Business Tax Fairness Act, again, we'll talk on this in a moment. Again, looking at the 20% deduction for qualified business income, he made some changes with that. That came out at the end of July. Just this last couple of weeks, he had two other bills. One is changing the taxation for derivatives. He had that, and then also the ended the carried interest loophole act. So any carried interest that you have would be cut back under the bill proposed by Wyden. One other thing that he's talked on recently is large IRAs, either regular IRAs or Roth IRAs, to perhaps some legislation to curtail that. Unsure what the specifics may be with that and whether that might be part of this reconciliation bill or whether that might be a separate bill. But that's something that he, along with the Ways and Means chairmen, have made comments about these large IRAs that are out there. So again, these are helpful items to see what may end up in the final package here that Wyden has pushed earlier this year. As I mentioned, I wanted to just spend a few moments on this Small Business Tax Fairness Act. Again, many of you may be familiar with this 20% deduction for qualified business income. Wyden introduced several changes with this in his package. A couple things just to note from this proposal that he had. First is the deduction would no longer be available for trusts and estates. Again, currently they can take that. They would not be able to with this. Next, married filings separately would not have this deduction available. Next, there would be a phase out. Again, this deduction is going to be available for those with taxable income under $400,000. Those above that would not get the deduction. There'd be a phase out range, it looks like, between $400,000 to $500,000, but $400,000 you'll still be entitled to this deduction. For some of the other changes that he would do, would actually simplify this calculation. Any of you are familiar with this 199 know that it's a pretty involved calculation with it. What they would do is just say any trade or business other than just being an employee would be entitled to this deduction. So we wouldn't have to worry about what they call a specialized service trade or business, or SSTB, which would be doctors or lawyers or professional services are generally not allowed for this deduction at higher income levels. They would just remove that distinction with it and just make it available for all businesses, but again, under that $400,000 of income level. And then they would also remove two requirements that you had to gather information for. One was the 50% of employee wages, and then the other was 2.5% of the adjusted basis of property. So you wouldn't have to track those anymore. And then, so that's sort of the overview of what this small business change would be. Here's just a brief little chart that kind of shows what the tax rates would be. Again, if you qualify for this 199A, this deduction, this 20% deduction, your top rate right now is 29.6%. If you're an SSTB, one of those professional service one, your top rate again is the top individual rate of 37%. If we do get a higher rate of 39.6 and then have this deduction taken away for those over $400,000, what we'll see then is that for a qualified business, their rate again will jump to 39.6, and the SSTB will also be at 39.6. So you'll see that's quite an increase. Again, for a business that's a qualified business, that's about a 33% increase in their overall tax rate and what their tax obligation would be. And for professional services or an SSTB, that'd be a 7% increase. And again, that does not factor in the 3.8% that Jenny had talked about before. So just a change on the rate. A couple other items here to note. When they go through the reconciliation package, it's again, there's a lot of special rules they have, and with it, and before they passed that resolution last week, right after they did the infrastructure bill, they have what they call this voter ram. A lot of amendments get offered up for any of the senators, and this is where the Republicans did have some input on the process, and they just keep voting until they run out of, until they get tired and want to finish it. I think they did that over a couple-day period. Number of amendments, a couple highlights with some of those amendments though that went through. One is the step up in basis that Jenny talked about before. There seems to be some, movement that they passed a unanimous amendment that would say that that would still be available for family farms and small businesses. So we'll have to see how that plays out into the bill, but there needs to be some bipartisan support toward keeping that step up in those cases. Somebody wanted to get rid of that, the keep the SALT limitation in place, and that failed along party lines. So that probably means that, again, there's going to be some changes in the SALT repeal of the SALT limitation coming up in the upcoming bill. Jenny also talked about the like-kind exchange, and it seems that there's bipartisan support. So even though that was part of the administration's proposal to have like-kind exchange limited, it doesn't seem like that may end up in the final bill. And there was also some support for the R&D credit and the R&D deduction. So you may see some changes with that perhaps in the bill, or at least not some limitations against it. And then one amendment, not really specific though, would prevent tax increases to small business. So again, not sure what that may mean, but I think that was more of a goodwill gesture that they put out there. So again, some of those amendments may play into what ends up in the bill. So what's next up in Congress here now as we move ahead? Again, they're off right now, but they are actively working on this bill, even as they're on their August recess. They extended the recess a couple weeks, and what they're doing now, all the Senate committees, again, that have this $3.5 trillion, each of them are working on their own portion of that. They're having virtual meetings, they're drafting it, and they need to report back to Bernie Sanders, who heads that budget committee, by September 15th with their bill. And that will include the finance package that Senator Wyden will put together for his one. So probably right around Labor Day or shortly after, you'll see some of these bills start to get released with some of the details with it, and those will all get packaged in. Again, what they're also working on is, again, there's a 50-50 split between Republicans and Democrats here. The Democratic leadership is going to try to shore up the support of all their Democrats so they can pass this. So they'll be working on that now just to see if anybody has any concerns with the bill, if they can try to work to address that to make them support the bill. Some possible defectors I mentioned before to keep an eye on would be Senator Manchin. I talked to before, and also Senator Sinema of Arizona might be one. So again, that's a lot of what's been worked on behind the scenes lately. The House, though, again, has been kind of, usually wants to have their input on these bills, and they've been left out, if you will, to some degree. They're coming back, their recess, they cut it short. They're going to come back next week. They're going to look at the Senate resolution for the reconciliation bill. They've got to deal with that. So they'll work on that next week. It's unsure if the infrastructure bill that actually passed in the Senate, if they will deal with that. There's some that want them to deal with that now and not wait, but the House has said all along that they were going to wait until both the infrastructure bill and the reconciliation bill are done before they bring it up. So it'll be interesting to see if they take up that infrastructure package sooner or wait until the reconciliation bill is all done. After that, they're going to recess and come back again the week of the 20th. So again, there's a lot of moving parts in the House and the Senate on it, but there is a sense of urgency that they want to move this, and they're going to want to move this in September here, I think. Again, there's a lot of different factions competing within the House on maybe moving that infrastructure bill again, maybe vote on that sooner. But the House, again, is under has a similar voting margins. Again, the Senate is 50-50. There's about a 4-vote difference in the House between Republicans and Democrats, so they don't have much wiggle room in the House as well. So they're feeling the pressure to get involved. And again, normally they're involved in the process. It's been interesting that they've been kind of put on the sidelines here, but they're going to want to put their stamp on the bill as well. So we'll see how that plays out in the coming days and weeks. So again, that's just an overview of where it stands. And again, as much as it seems like they haven't done a lot, you'll see a lot of activity here, especially when they come back here in September and look to push that through during the month. So here we've got our third and final polling question for you here. We'll go through that. Just pretty a yes or no here. Do you think a major tax legislation from the reconciliation bill with a lot of the individual and business changes will pass this year? Yes, no, or unsure. So we'll give you a chance to offer your opinion on what do you think will eventually happen here. Okay, we'll give a few more moments with that. Again, just to get just your observations with what you think may happen here in the coming weeks.
Jim, while you're waiting on that, we did have a quick question come through, just a speculation of, has there been any recent talks of changing the estate exemption amount?
I have not heard any on that, Jenny. A good question with it. I know that's been talked on, and there was some talk even when the American Families Plan came up that they may change that. Have not seen anything with it. If they, some talk is if they do scale back and allow the step up in basis, that there may then be maybe a change in the exemption, but have not seen anything specific. And again, they're keeping some of that close to the vest here, and I think probably again within the next week or two we'll find out for sure on that.
Right.
Good question though. Okay, here's what we've got here. About 2/3 of you here saying yes, that this major tax legislation from the reconciliation will pass. Again, 20% no, and then a few unsure with it. So that's probably a good indication, I think, of where a lot of folks think what may happen with it. So, okay, good. Well, moving on from that, what we thought we'd do now, and Jenny mentioned it before, is we're going to go through some tax planning observations. And again, some of these we had before we covered this, but we thought we didn't really get into them as much in depth. And again, I think these are still some things that, with these possible changes looming, what can you move ahead with? So we're going to go through those. We've got a number of the ones here. Jenny will go through some, and then I'll go through a few other ones with it. So Jenny, let's go through just some practical observations, some things that you and your business can start looking at with these possible changes looming here relatively soon.
Perfect. Yep. Thanks, Jim. Yep. We have a couple of items. I know these slides have been in a previous presentation, but we weren't able to cover them. So we did want to spend some time on them today and really talk about them to get them, top of mind in regards to as we get closer to an actual reconciliation bill, because that's when they're going to become meaningful. And really, they should be spurring conversations you're having right now within your business, within your homes, or with your advisors. There are a lot of uncertainties. Some of the questions continuing to roll in will be, will the tax increases be effective in 2022 or in 2021 retroactive? And we don't know. As time moves on, I think the general consensus is it would be hard pressed for items to move backwards, but it's happened before. So we kind of have to wait and see and kind of line some of these things up to put yourself in the best possible position to react or act with some of these items in mind. So in regards to some of the planning ideas, these are not all inclusive, but a few items that want to be talked about right now. And in general terms, the biggest thing when you're looking at potentially increasing tax rates is really thinking about the timing of your income recognition, right? So against traditional tax planning, where you're always looking to defer tax as long as possible, you want to consider areas where you're going to have the flexibility and ability to accelerate taxable income into that lower tax year. So whether it be something you can actually act on right now, there's a lot of different areas and timing when you can do so. If you haven't filed your 2020 tax return yet, there are still items you can do on that 2020 tax return. Now we just have until September 15th or October 15th in most situations, but you could do something in regards to your depreciation elections. You could do something in regards to a change of accounting method that would pull income back into that 2020 tax year if you're feeling, and we continue to get the feeling that this income would be taxed at higher rates, maybe not only in 2021, but maybe more probably in 2022. So depreciation is one way to really focus on that. Changes of accounting methods are timing difference items that move the fundamental way and timing of when you recognize income for tax purposes. So those are items to explore with your advisor. But my, I guess biggest word of advice is not that we ever want to let tax totally drive your business and the decisions you make, but be cognizant of larger spends you're having right now, whether it be asset acquisitions, contemplating bonuses, and timing of those payments, because the timing of that payment or execution of that could become critical as we get to the end of 2021 and going into 2022. So these are the theme of this slide here is really to model out those potential bigger spends, seeing where the time value of money sits versus different tax rates, and knowing some of those areas that you may be able to defer timing on or accelerate timing on. And then obviously the big item where we would see potentially the highest tax rate increase would be evaluating your capital gains strategies. Along these lines, you really want to look at potentially, in one case, either accelerating capital gains, because we know what the rate is right now, and at 23.8%, there's the chance it'll still be there. There is a lot of uncertainty. That is one of the items that in various proposals or that administration plan, they indicated they could make it retroactive. Again, that could be one of the items that it would be very hard for them to get by it or even get through the reconciliation process with a retroactive move on that. But be cognizant that maybe there's a way, even on your 2020 tax return still unfiled, to pull that gain in, or to be planning on timing of moving forward with potential transactions. If we do get into a higher capital gain rate environment, for sure, keep in mind, or right now, if you have donative intent and charitable intent planned, to really investigate some of the measures that are in place where you can donate appreciated items, so that you're not recognizing the gain on those items. So again, if you're thinking right now about a large type of donation, try to map that out and start talking to the right advisors so you can put the steps in place to maybe do that as a donation of appreciated property, and therefore not recognizing a gain when we're potentially in very high capital gains rates in the future. So there's a few items related to that on this slide. And then when it comes to capital gains with maybe selling a business or selling certain assets, fundamentally there's installment sale treatment. That's a principle that's been in place for a long time in regards to a taxpayer can elect if they're not going to receive the payments on that overall sale. Again, this comes into play with very significant size transactions. Typically, maybe there's an earn-out period or a period that sales proceeds is going to come in. Typically, you could elect to first recognize that gain ratably over the period when you are actually collecting those proceeds, which, in traditional tax planning environment, that would, be an incentive because you're deferring that tax as long as possible. But in this environment, you do want to consider for installment sales that occurred in 2020 and maybe you haven't filed that tax return yet, or are occurring in 2021, to potentially elect out of that installment method. You do want to look at all the factors that come into that transaction, because what that does is triggering the gain on those entire proceeds that you are anticipated to receive in the future now. So running your time value of money, running your proceeds analysis on that, but also considering obviously the potential for repayment and other things that could affect that installment receipts. One item of interest out there is that maybe you already have an existing installment sale that was executed several years ago and you are still receiving payments on that. So again, continuing to recognize capital gains each year on those payments, and we'll be doing so for several years into the future when we know we might have much higher capital gain rates. So if there's anything you can do on that, you can actually trigger that gain, even though you haven't received the remainder of those payments and we're past that initial year normally when you make that election to either recognize it fully or recognize it on installment, you can trigger the rest of that gain by actually just pledging that note as security for using it as security for another loan. So that would trigger the gain and recognize that capital gain sooner. Or if there's a certain way to actually receive those payments earlier, that would be another way. So things to look at if you're in an installment sale agreement right now, or potentially entering into one in the near term. You really want to evaluate the potential timing to move those capital gains. Staying with the theme of capital gains, think about the idea that capital losses could potentially be much more valuable in the future. So again, another traditional tax planning measure would be potentially harvesting losses to offset gains in any particular tax year to minimize your gains and again defer that timing. So this would involve working with your investment advisor certainly and making sure you're making decisions that are smart for your portfolio overall. But if you have capital losses in your portfolio, you may want to maintain those and save those, because they would be much more valuable used against a 43% rate in the future than potentially a 23% rate right now. That all comes into play with monitoring when the effective dates of this legislation might happen and what we actually push through. But these are items to be thinking about and talking about now, so that you're poised to react or act and take into consideration right now, even knowing what we know.
Good.
So Jim's going to lead us through a few more here.
Okay, very good, Jenny. There's some good items going through the change in tax rates, regular rates, as well as the changes with capital gains and losses. Very helpful to get a handle on that. So thank you, Jenny. A couple other items to be aware of, some possible planning. One would be, again, a lot of closely held businesses are set up in S corporation, again with one layer of tax. And one thing, if the S corporation was previously a C corporation, one thing it tracks is what many are familiar with, what they call its AAA, or its accumulated adjustments account, and any distributions are paid out of that. And then once that AAA is exceeded, it goes to the company's earnings and profits when it was a C corporation and taxed at a dividend. So again, companies usually do that and usually don't want to have it taxed as a dividend, but there is a special election that's available for an S corporation. And what it could do is it could elect, again, if all the shareholders agree and consent to this, to have those distributions for a year instead taxed at first paid out of the E&P, so it's taxed as a dividend to the shareholders, and then next after that out of the AAA. Again, that's an annual election that's made with the S corporation tax return. Again, you might do that while that dividend rate may still be at a 20% or 23.4%, lower rate that you could do, to maybe look at making that election, because once the capital gain rate goes higher and the dividend rate goes higher, that's going to be up at a 40% or 43% rate. So that's something, again, that can be done on the tax return for the S corporation, again, as long as all the shareholders consent to that. And there's a similar provision to it that you just make a deemed election. You don't even have to actually have the distribution out, where all the again, the shareholders consent to that, and what you have is you have a deemed payment of the of that amount, so you can pick up that earnings and profits. It's deemed paid out and then contributed back to the company again. So that's something that you may want to be aware of, that again you could do for this year or next year, again depending on the effective dates. Next is one that we've talked on some in the past with it. It's section 1202, and it's this qualified small business stock. And again, this company would be taxed as a C corporation, which again, not as a pass-through company, so it's at a C corporation. But again, if you're not distributing out that income, the C corp rate is actually less than individual rate, so there is a current cash flow savings with it. But the real benefit with section 1202 is that if you invest in that stock, meet all the requirements, and hold it for 5 years, any gain on that stock sale, that 1202, could be 100% excluded from the income tax. You avoid all this 43% capital gain tax that you have with it. It also avoids AMT, so that is also excluded for AMT purposes. So something to be aware of. Again, some companies are exploring this 1202 here. Just a couple of provisions: to be a qualified small business, needs to be an active conduct of a trade or business. So generally does not apply to service businesses. So just be aware of that. The initial gross assets of the corporation are less than $50 million, and you need to be the original issue of the stock from the company. You can't be getting it from another stockholder. And you usually have to put in cash or other property of the corporation. So a number of specific rules to follow with it, to work with your tax advisor or legal counsel with, to make sure that you qualify for it. But again, if you do and you hold it for that 5 years, you could really do quite well here on the back end with the sale with it, having 100% exclusion. Next item here with it, again, with the lower rates, a couple things that we're looking at is, what should your, we had that with the tax reform went around a couple years ago with the Tax Cut and Jobs Act. Should companies maybe switch to a C corporation or stay as a pass-through? Well, when rates change possibly this time, that's probably another exercise to explore, what makes the most sense for it. Again, at this point, it seems that with the changes that they're considering, that it's probably still going to be better to be a pass-through, again, because if you distribute out that income, pay a dividend with it, and you're in the top rate of 43%, again, you're going to be at a higher rate at the shareholder level, with the double tax that you have involved here. And we put down here, it's about a 14% higher for that than a pass-through entity with it. So just something to be aware of. However, again, if you don't plan on paying out that income and you want to reinvest it, as we talked about with that 1202, again, that 25%, if that's the rate where the C Corp rate moves up from 21 to 25, that's somewhat the expectation. If they do change the corporate rate, it would go to 25%. Again, on a current basis, the current tax that a company would face, that's still going to be less than a pass-through if you don't pay all the income out. So that may be something to explore as well. So again, something that people will start modeling, as Jenny talked about, once we find the final details and the effective dates.
Thanks, Jim. Yeah, that was one of our specific questions, if this is a good time to review S Corp versus C Corp status. And I think your points are spot on there. I think that's one where we're really going to have to wait for the actual rates to fall, so you have the final numbers to use in that analysis. But thinking right now in regards to your business model and how much you distribute versus invest in ongoing business, as well as the long-term lifespan of that business, are the things to really think about the intangibles before you can put the specific rates to the numbers in that calculation.
Yeah, very good, Jenny. Yeah, I think that's going to be a good exercise to get into modeling. And then our last item here is kind of an interesting twist on it. With any merger and acquisition transactions, again, one of the things you always have when you have a transaction, if it's an asset, sale with it is, trying to qualify if you're the seller for capital gain treatment, you get the 20% tax or 23.8% with it, and avoid ordinary income, which is up to twice that rate. But if the capital gain rate that becomes the same as the ordinary income rate, that may change the dynamics in a sale of a business. The seller is probably going to be at least more willing to accept ordinary income on, let's say, machinery and equipment and less on intangibles because, again, they're going to be taxed at the same rate. But the buyer could get a much faster write-off for its machinery and equipment because that would be a 1-year write-off as opposed to a 15-year write-off. Less concerned with hot assets for partnership items. A seller is also willing to perhaps accept some allocation to compensation. Again, that's usually ordinary income, but if that's going to be taxed the same as capital gain, they might be willing to take some additional compensation income from the transaction, but the buyer gets a current year write-off as opposed to a 15-year write-off. So these are just some of the items that, again, once we get the final details and the final rates, that this could change the dynamics of any transactions going forward, and I'm sure other strategies will emerge as well. So anyway, those are just some planning ones that Jenny said to start thinking of and start looking at with it. And I think there'll be more things that will come once we get the details. And again, I think that's probably going to be right around Labor Day or early after that we'll see some of the specific details with it, and then you'll see them trying to pass that through both the Senate and the House. So again, Jenny and I would like to thank you for joining us today. At the conclusion of this webinar here, a short survey will pop up with it, which again, you need to complete that for your CPE for the session. The CPE certificates will be emailed to you approximately 2 weeks after this program here today. They'll ask if there's any other questions you had that you didn't get in the chat feature today. You can also put those on the survey. So anyway, with that, again, we appreciate all your help, and thank you for Jenny and I working through this with it. Thank you for your understanding and listening in, and we wish you all the best. Have a great day. Thank you.
Thank you.
Bye-bye.